in this case, if I sell a property out of a family trust, then it would be my standard CGT rules that apply to the calculation of proceeds and base cost, right? So base cost would follow my normal para 20. It's the expenditure incurred on the acquisition of the asset plus any improvements to the property, plus any legal expenses for maintaining your legal title, right? Reduced by any allowances that you could claim. Proceeds is the amount received by or accrued to as a result of the sale of the property, less any amounts included in gross income or taxable income as a result of the sale. So recoupments, dividends, that kind of thing would reduce your proceeds. So there really is at that level, the sale of the property out of the trust does nothing unusual. It's really only in the next step where we have a certain change. If that capital gain stays within the trust, then we have to remember that the trust inclusion rate is 80%. And because the trust has a fixed income tax rate of 45%, we would effectively pay 36% tax on the capital gain, being 80% or 45%. However, as long as your trust deed it allows for such a distribution. Not all trust deeds are created equal. Remember, your trust deed has to specifically allow for this. Then, if your trust deed allows for the distribution of the gain, then you can, in terms of the provisions of para 80, make the move the tax liability for the CGT from the trust into the hands of the beneficiary. There are, however, three really big provisos that we need to remember for this. First things first, we can only distribute for tax purposes, CGT to non-residents. If, in terms of the trust deed, I distribute the capital profit to a non-resident beneficiary, perfectly entitled to do so, the non-resident beneficiary is still going to get that amount. But from an income tax point of view, the tax would stay payable in the trust and not pass on to the beneficiary, right? Para 80 also makes it very clear that you can only drop down one level. Okay? Whichever trust triggered the capital gain can pass it down to one level to another beneficiary, be that another trust, individual, company, or whoever. Okay? They can drop it down one level, but they can also only give a CGT effect that is equal to the amount available for distribution. Now, this is a very common problem in trusts. If your accounting profit is less than your capital gain, which can happen if you've had revaluations, for example, or if you've had differences to expenses that were capitalized to the base cost, or if there's adjustments that you have to make to proceeds. There's a couple of different ways in which you can get there. Then I can only distribute the capital gain to the extent that I actually have a profit available for distribution to my beneficiary. So please be very careful. You cannot just, if I have R1 million worth of accounting profit, but I've got 1.2 million rands worth of capital gain, I can only distribute R1 million to the beneficiaries. 200,000 would stay taxable in the trust. Right. So the other thing that I would emphasize here is that if this is a very big concern for you, if this is something that you would like to spend a little bit more time looking at, my suggestion would be that you go and have a look at the Comprehensive Guide to CGT. I'm going to say here my standard. If you go and have a look at the SARS website, go to types of tax, and you go and have a look at CGT. The Comprehensive Guide to CGT, if you look at a new page, I believe it's chapter 15. If we scroll all the way down to the bottom, chapter 14. Chapter 14 goes through all the possible different permutations that you could have with CGT in trusts, with the varying different permutations and potential issues with trusts. You'll see there's close on 60 pages worth of discussion with examples on how you deal with CGT and trusts. It's a fantastic little resource, definitely worth doing. Also, you may recall or may have heard in the news over the last 2 years that there was discussion that because remember I said a trust can only drop down one level, it can't drop down more, right? However, that was based on an ITC case. That case then actually went through to the High Court and to the Supreme Court of Appeal, and the Thistle Trust case was, yes, the Thistle Trust case was then decided at the end of last year, and the Thistle Trust case would override that tax case presentation, and it made it abundantly clear, which says it is one drop down level and that is it. Okay, so we now actually have binding case law because it has precedent value, and that's the approach that we're going to have to take.